Very good evening, friends, and thank you very much for joining us. My name is Ganesh from HDFC Securities, and the topic for today's discussion is ETFs, that is exchange traded funds. Today, we're going to be discussing about the new fund offer from Mirae Asset Management, which is the Mirae Equity Asset Allocator Fund of Fund. Asset allocation model. Why an asset allocation model should be an extremely important part of every investor's portfolio, and how ETFs play a very, very vital role in complementing this. To tell us more about this, we have with us a very distinguished personality, Mr. Siddharth Srivastava, who's the head of ETF products for Mirae Asset Management. Mr. Siddharth, thank you very much for joining us. Pleasure to have you with us. Okay, and it's over to you now.
Yeah. Thank you. So, good afternoon, everyone. Hope you and your family is safe and healthy. So, Mirae Asset is coming up with a very interesting new offering called Mirae Asset Equity Allocator Fund of Fund. The NFO starts on 8th of September and ends on 15th of September 2020. So before I talk about what this fund is all about, let me give you a brief background about ETF and asset allocation and why those two things are one of the most important things in investment community right now. So from a presence point of view, Mirae Asset in India has been known more so from the active mutual fund side. We have a decent presence on the equity mutual funds and on the debt mutual funds offering. But globally, we have been present in the passive side, especially on the ETF side in a lot of countries. In fact, we have ETF specialized companies present in 9 countries like Horizons in Canada, Global X in US, Beta Shares in Australia, and all these companies are owned by Mirae Asset Group. All in all, we manage around 370 plus ETF with a total AUM of $38 billion. So we are one of the bigger players in the passive industry globally. And with that intent to provide the similar product offering, to provide the benefit of ETF product, we ventured into passive side in November 2018, and post that we have been building our product offering. So why are we talking about ETF? ETF per se are products which invest in the underlying index. So for example, a Nifty 50 product will invest in the 50 securities which are forming part of Nifty 50 index with an aim to give you similar returns which Nifty 50 is giving. So such sort of products are gaining huge traction globally. Right now, the entire ETF industry is around $6.3 trillion, which is twice the size of India's GDP. In fact, out of this $6.3 trillion, $5 trillion has been added in last 1 decade alone. And the reasons are simple. It's a very convenient product. You typically get the returns of the segment you are investing in based on the index performance. There is no manager risk involved. It's a very, very low cost product compared to active mutual funds. And you can buy or sell ETFs on the exchange. Such has been the traction in this particular segment that last year, the total AUM of passive products in equity passive products in US overtook the total AUM of active mutual fund based equity products in US. So such has been the tectonic shift towards the passive side globally. And we are starting to see similar sort of trends in India, where right now ETF industry stands at 2.1 lakh crores. Rewind 5 years back, it was only around 10,000 crores. So from 10,000 crores to 2.1 lakh crores, it's a huge momentum which we are seeing. And one of the major reasons for this is that even the government is now using CPSE ETF for disinvestment purposes. In fact, you might be aware or may not be that your provident fund money from by EPFO is getting invested in equity market through ETFs. So knowingly or unknowingly, if you have a provident funds account in EPFO, you are already in a way an ETF investor. So we are seeing a huge traction in the growth of the AUM of ETF industry, even in India now. And one of the major reasons why this happens, why ETF gain so much traction over a period of time is, and this particular thing happened in US also, that as market becomes more efficient, the active mutual funds find it increasingly difficult to outperform the benchmark. And this particular slide illustrates that a Nifty 50 ETF, which invest in those 50 stocks forming part of Nifty 50, has outperformed 92% of large cap mutual funds by an average margin of 2.6%. If I talk about Nifty Next 50 ETF, which invest in next 50 large cap stocks, ranked 51 to 100 in the large cap category, they have this particular simple product has outperformed almost 96% of active large cap active mutual funds by a margin of almost 2% plus in last 7 years. So what people starts to observe is okay, while active mutual funds try to outperform the benchmark, talks about alpha, talks about outperformance, it is very difficult to generate that. In fact, in race to outperformance and race to alpha, they may end up underperforming also, and such underperformance increases significantly as and when market becomes more and more efficient. And that is what we are seeing in India, especially on the large cap segment side. And hence, a lot of these mutual funds are finding difficult to generate a simple market returns, provide you returns which are similar to Nifty 50 ETFs or index funds. So I think it's a very good time right now to start having exposure in such ETFs or such passive products. It's not a question of or whether you invest in the mutual funds, the active mutual funds, or you invest in ETFs or index funds. It's a question of and. Let's say a 20 or a 30% of your portfolio can be invested in such passive products like ETFs, where you will be able to get the market returns at a very low cost. For example, a Nifty 50 ETF right now is available at just 8 basis points compared to an active mutual funds which are in the north of 2%, right? It's more, it costs more than 2% to own that on the regular plan side, whereas Nifty 50 ETF is available at just 8 basis points. So by having such a low cost, you are getting market returns, you are avoiding the fund manager risk, which is there in case of active mutual funds. So start thinking about having some of your allocation in such passive products. It will reduce the cost of your overall portfolio, right? And secondly, there'll be a portion of your portfolio which will give you the market segment returns where your particular index funds or ETFs are investing. Now, then post ETF, what is one of the most important thing which leads to wealth creation? Apart from investing in right segment of the market, it is also important to manage your asset allocation. It is also important to take broader exposure to multiple segments, multiple asset classes, and within equity, take exposure towards large cap and mid caps. Because see, all these market segments perform differently in different market cycle. There will be period when large cap will give you a better returns than mid cap, and you can see what has happened in last 1-2 years when simple when Nifty 50 ETFs or large cap funds have fared better than what mid caps have. But if you rewind back to 4-5 years, mid caps were doing well better than the large cap. So from an investor point of view, it is important that you have right allocation to a broader segment of the market. You have allocation in, let's say, large cap also and mid cap also, and then manage your asset allocation so that based on those asset allocations, you are able to generate extra returns because you are invested in the right segment of the market. And a simple illustration is this particular slide, a scenario one, which talks about that you are only investing in winners. So let's say if you invest only in the market segment which has performed well in last year, if you keep on doing that, you generate just 7.4% returns, and this we have back tested for almost last 15 years. But in scenario two, if you invest 70% in large cap and 25% in mid cap and 5% in small cap, you get a far better returns of almost 12%. because in this scenario, in scenario 2 and scenario 3, you are having a broader exposure to the market. Whenever a segment is performing better, you are participating in that rally, and your overall risk of the portfolio also reduces because you have diversified your portfolio. That is why asset allocation and managing that asset allocation matters a lot if you want to create a long-term wealth. And we feel at Mirae Asset that ETF can be one of the better ways to do that asset allocation. Why? As I mentioned earlier, it is a very low cost medium. It gives you market segment returns. It removes the fund manager risk of underperformance by simply tracking the underlying index. The rebalancing is less frequent within these indices, and that is why the cost of managing, or rather the impact of such rebalancing, is very low. And then also equity taxation continues to apply. So because of all these factors, ETFs are a very right product to use to manage asset allocation. For example, if you want to invest in large cap segment, you can use Nifty 50 Next 50 Sensex ETF to take that exposure at a very low cost. If you want to invest in mid cap, you can invest in mid cap 100 ETF or a mid cap 150 ETF and get that mid cap segment return again at a very low cost. And you can avoid the fund manager risk of underperformance. The entire investment will, since it is being based on an index, it is much more transparent in nature, because these ETFs are simply replicating the underlying index, whose portfolio are available and known to the investor on a daily basis. So ETF hence provide market exposure at a very low cost and with no active risk of the which is generally associated with the fund manager. So the idea behind coming up with Mirae Asset Equity Allocator Fund of Fund was basically to provide a very convenient way to take passive exposure to the broader segment of the market through ETFs, so that the cost of the product remains low. There is no active fund manager risk per se, and then you also in this particular fund we are managing asset allocation, so that at all times you not only you are taking a broad market exposure, but depending on the valuations, your allocation is being shifted in large cap and mid cap space, so that you get best of both worlds. So that was all about ETF and why asset allocation is so important. Let's move to the topic of the day, which is Mirae Asset Equity Allocator Fund of Fund. So let's first talk about what is the intent of this fund, right? Why we are coming out with this fund of fund offering now, and what sort of solution it provides. And I'm talking about solution because we feel that it's a solution product which addresses a lot of investor queries, which provides very convenient solution for investor to participate in the equity market. So from the intent point of view, the Mirae Asset Equity Allocator Fund of Fund will invest in the entire large and mid cap segment by investing in multiple ETFs. So basically you will have the exposure to all 250 companies which are present in the large and mid cap segment, and we will do this by investing in multiple ETFs, mostly Nifty 50 Next 50 and mid cap 150 ETF. And while investing in these ETF, what we will also do is we will manage the asset allocation. What do you mean by that? Is that today if we are investing, let's say 75% in Nifty 50 ETF to provide you exposure to that top 50 stocks, tomorrow if we feel that this particular segment is overvalued, we will reduce that allocation from 75% to, let's say, 70%. And similarly, we'll increase valuation allocation to, let's say, mid cap if we find that mid cap right now is available at a cheaper valuation. And that is how we will do the asset allocation, and I'll talk about more in the later part of the presentation on how we are doing asset allocation. But by doing that, we are trying to give you some additional returns, some additional alpha over and above the market segment returns. So while we are investing in these three mid caps, we are trying to give you large and mid cap segment returns, but because of asset allocation, we are trying to generate some additional returns over and above the market segment returns. And what are the benefits of using ETFs, right? We have already addressed it, so but I'll still reiterate, is that since we are using ETF as the underlying investments for this fund of fund, the overall cost of this fund of fund will be very cheap. A direct plan of this fund of fund will be available at 20 basis point, including the cost of underlying scheme, and the regular plan will be available at just 30 basis point, including the cost of underlying scheme. So that is just 0.2% for direct plan and 0.3% for the regular plan, and that is how cheap this particular product is. It is much cheaper than the active mutual funds, whose regular plan can be in the north of 2%. It is actually cheaper than the index funds, where the mid caps and Nifty Next 50 index funds are at a higher cost. So from a cost point, this makes a very compelling product. Also, what we have done, one very interesting thing is that we have not kept any exit load on this particular product. The reason behind this is that there are two type of investors who can basically invest in this fund of fund from the investment and horizon point of view. One, a long term, an investor can take long term strategic can do long-term strategic investment in this fund of fund just to get large and mid cap segment returns and exposure to large and mid cap segment. And let's say if he invests 20% or a 10% of his portfolio in this particular fund of fund, he will simply get large and mid cap segment return plus some additional alpha because of the asset allocation at a very low cost, and he can have an investment horizon of, let's say, 3-year or 5-year, and enjoy the wealth creation through this fund of fund. The second set of investors can do a short-term allocation also. For example, right now, one of the most important question in the market is that if you feel that the large caps are at a very high valuation, it seems expensive, but you're not sure whether you want to invest in so in this unsure times, let's say, you can park your money for some time in this fund of fund, and when after 2-3 months you have made a decision and you want to move to a different segment of the market, you can take out the money from this fund and invest in another fund without the worry of exit load. So I think from solution point of view, it addresses the requirement of a long-term investor also, and a short-term investor also who just want to park his money for the time being. Lastly, earlier all funds of funds were categorized as debt-oriented schemes, and debt taxation used to apply. But now, because of rule changes by income tax authorities, now what will happen is a fund of fund which is investing in equity ETFs will be classified as equity-oriented scheme, and equity taxation will apply. Hence, now by investing in this particular fund of fund, you will also get the benefit of equity taxation. So all in all, we feel that it's a very compelling product because it caters to a lot of concerns and queries around investing in equity market. Which segment should I invest in? How do I take a broader exposure to large and mid cap segment? Which fund should I invest in? How do I rebalance my allocation? How do I maintain the cost of my entire investments low? How do I address the cost and tax incidents associated with the rebalancing of my portfolio? And lastly, how do I invest in ETF and basically buy and sell ETFs on the exchange? So all those things, now you just you can relax if you invest in this particular fund of fund, because this particular scheme will take care of all those issues by investing in large and mid cap segment through ETFs and doing the asset allocation internally depending on the valuations to generate some additional alpha. To put it very simply on how the investments will be done in this particular fund of fund, as I mentioned it earlier, this particular fund of fund will predominantly invest in Nifty 50, Nifty Next 50 and Midcap 150 ETF. And by doing that, it will provide exposure to all top 250 stocks of the market. And these 250 stocks capture around 91% of the entire equity market. So through this fund of fund, you are getting exposure to the 91% of the market, and through this single scheme, you are basically removing the inconvenience of investing in multiple ETFs and taking that single exposure through a single scheme itself. Now, let's take a very simple example on how the allocation is happening and where your money will be invested in. In a normal scenario, the allocation will be based on market cap representation of these ETFs of Nifty 50, Next 50 and Midcap 150. For example, let's say Nifty 50 represents around 75% of the market of large and mid-cap segment. 75% will be allocated in Nifty 50. Then, as you can see in the table 1, 10% in Next 50 and mid-cap around 15% in Midcap 150. And this we have derived based on what these particular indices capture in terms of the overall large and mid-cap segment of the market. Because see, intent of this product, as I mentioned earlier, is to give you returns of the large and mid-cap segment, and that we can only give you if we are investing around based on the MCAP representation of these underlying ETF. But we will do the asset allocation, as I've mentioned, with an intent to generate the outperformance and generate the additional alpha just because of allocation. And what we'll do is we will keep a very tight range of plus minus 10% of movement. So for example, if Nifty 50 on an ideal scenario, Nifty 50 investment should be around 75%. What we'll do is if Nifty 50 is very expensive, then it can go as low as 67.5%, and if it is very cheap, it can go as high as 82.5%. And similarly, as you can see in table 1, allocation will be done in Next 50 and Midcap 150 also. On the midcap side, on the higher side, typically allocation will touch 20% if midcap is very attractive, and on the lower side, the allocation may touch 10% if it is very expensive. So we'll be looking at earning estimates, seeing what sort of earning estimates the companies are giving within these indices, and determine the forward PE of these indices to gauge whether these indices are trading at premium, or rather by premium I mean that whether it is overvalued or are trading at discount. By discount I mean whether it is right now available for a cheaper price than it should be. So if it is trading at premium, we will under allocate. If it is trading at discount, if it is available at cheap, we will over allocate. And by doing simply this function, right, we will try to generate that outperformance. I think in terms of it may sound technical, but aren't we all doing the same thing? For example, if you are investing in ABC stock, and you what you do is you look at the prices right now, you look at the PE and see whether currently this particular stock is available at the attractive valuations. And how do you do that? By comparing with the historical valuations, by seeing whether in history at what valuations or at what levels this particular stock traded. If you find that stock to be attractive, then you buy more, and if you find that this stock has now become expensive, you sell it. And same thing in a way is happening in this allocation exercise also. We are buying the underlying ETF more if it is undervalued, we are selling it if it is overvalued, and hence maintaining the asset allocation based on the current valuation and based on how attractive a particular market segments look like right now. And this particular idea or rather allocation, we have back tested, we have tested it for over last 14 years, and what we are seeing is that over and above the market segment returns, it is giving you almost 1% of additional returns just by managing the simple asset allocation. So 1% may not sound very high, but you have to, as I mentioned earlier, you have to look at the fact that this market segment returns itself is so high, or rather so important that that people are struggling to outperform it or other mutual funds are struggling to outperform it on a consistent basis. So just by doing asset allocation, if we are able to provide you, let's say 80 to 100 basis point of additional returns over long term, on a medium term basis around 50 to 60 basis point of additional returns over 3 or 5 year horizon, it is still significant, because you are doing all that by investing in a low cost fund where the fund manager risk of stock picking is not involved, and you are still in a way seeking to get market returns of large and mid cap segment by taking a very broad exposure. So just to summarize why you should consider this product, it's a very low cost way at 0.2% and 0.3% for direct plan and regular plan to take exposure to the entire large cap and mid cap segment. These two segments capture around 91% of the entire market. Apart from that, we will be doing asset allocation in the underlying ETFs, changing that asset allocation based on current valuations and future attractiveness, so that we generate some additional returns over and above the market segment returns. One very important thing which will happen here is that since the allocation is getting taken care by the fund of fund itself, all the tax incidents which may incur directly, which may incur to the investor if he would have rebalancing his portfolio by himself. Let's say if you're selling a mutual fund, you may incur short-term or long-term capital gains. All those things will be getting absorbed by this fund of fund, and those tax incidents will not arise for the investor. And because this fund of fund is like a normal mutual fund, right? You can subscribe or redeem like a normal mutual fund. You can do SIPs like a normal mutual fund, and you don't need a demat account, which you typically need if you are buying or selling the ETFs. Also, there's no exit load, which I have mentioned, and hence you can park your money for a short time basis also. And with all that, now you are also getting the benefit of equity taxation, because this particular fund of fund is investing only in domestic equity ETF. So finally, the NFO has already started. It started on 8th of September. It ends on 15th of September, which is next Tuesday. The benchmark is Nifty 200 index. You can also do the lump sum investment in addition of 5,000 rupees, and you can also opt for the SIPs, which are typically not available directly from the AMC in case of ETF. So all in all, a very solution oriented, a very convenient offering, which will allow investor to take exposure in the entire large and mid cap segment through ETFs with a very low cost, without exit load, with equity taxation, and you need to basically it reduces the worry about asset allocation also, because all those things are taken care by this fund of fund only. So that was it from me on the presentation side. Happy to take any questions which the investors has on this particular of rather very interesting offering from Mirae Asset.
Great. Thank you so much, Siddharth. I think it was quite an insightful session, very informative. Yes, we do have some questions, and I'll bounce it off to you one by one. Okay. Now, the first question goes like this: how does this compare with a standalone large cap fund or a mid cap mutual fund? You hold both of them on a standalone basis.
Okay. So what do mutual funds do? Mutual funds invest in stocks based on the fund manager style, or based on the fund manager. If he feels that a particular stock is appealing, he can invest in that particular stock and take position there. So a large cap mutual fund typically invests 80% of its corpus at least in the underlying stock, in the large cap stocks. Whereas this particular scheme is investing directly into ETFs. So it is not taking a stock call. It is basically investing in Nifty 50 ETF, whose underlying is all 50 large cap stocks. It is investing in Nifty Next 50 ETFs, whose holding is next 50 smaller large cap stocks, and it is also investing in mid cap 150 ETF, which holds all 150 large mid cap stocks. So all in all, through three ETFs, this particular fund of fund will be exposed to all 250 large and mid cap stocks, and in a way participate in the performance of the entire market segment of large and mid cap, whereas your large cap or mid cap mutual funds will only provide you exposure to the stocks in which they are investing in.
Great, thank you for that. The next question is from Mr. AR. What assets and asset classes would be held in the fund of fund?
So this is an equity allocator fund of fund. So we'll only invest in equity ETFs, and that too in ETFs which are predominantly investing in large and mid cap stocks. So even this particular fund of fund will not invest in a small cap ETF.
Great, thank you for that. There's another follow-up question on that. How adaptable and agile would the fund be to market volatilities? Just to add to that, since you also mentioned about an investor, looking at it on a short-term basis as well.
So since these are investing, this particular product is investing in the underlying ETFs, it will simply give you returns and volatility which is associated with large and mid cap segment, and the base allocation is around the market caps. So whatever large and mid cap segment in totality is giving you returns and volatility, it will be in a way replicated by this fund of fund, subject to the condition that since we have internal asset allocation which will move weightages in these ETF based on their current attractiveness, current valuations, there might be a difference of performance and there might be difference in volatility, but it will be very small in nature, because as I mentioned in this slide, it's a very range bound deviation which we are doing. Nifty 50 is being allocated plus minus 7.5%, that's it. So it will be a very range bound changes in terms of performance and volatility if we compare it with the large and mid cap segment as a whole of the market.
Great, thank you for that. The next question is from Mr. Venkata. How to apply for this fund using HDFC Securities? I'll take this one. So Mr. Venkata, you can log into your HDFC Securities trading account. Once you log in, on the top right hand side, you will find a tab called Mutual Funds. Once you click on that, under Mutual Funds, you will have another tab called NFO Watch List. Under this, you will be able to find this fund called Mirae Equity Asset Allocator Fund of Fund. The next question is from Mr. Partho. Isn't this a product similar to the Mirae Asset Emerging Blue Chip? And if one is already holding that, how much would you advise for? Would it make sense to go for this one too?
Okay, so I think this particular fund of fund is very different from Emerging Blue Chip Fund of Mirae Asset. Emerging Blue Chip Fund typically has a very balanced exposure towards large cap and mid cap stocks. It invests in the underlying stocks, so it has a very balanced exposure if you look at the portfolio. Whereas this particular fund of fund, first of all, it will invest in ETFs, tries to give you the market segment returns, plus predominantly it will be a large cap bias. So mid caps will only have, let's say, around 20% allocation, even on the higher side. So around 80% will be based on large cap ETFs only. So hence it is very different to EBF, which tries to outperform the market and has much more balanced exposure towards both large and mid cap segment.
Okay, the next one is from Mr. Deepak. Who would like to have a view on the long-term trajectory of the market. Just to add to that, considering the current situation, given the current context of your earnings growth coming under stress, okay, the first 2 quarters have already got affected, and the next 2 quarters also seem to be a little stressed as far as the earnings growth coming through are concerned. So, what in your view would be a long-term trajectory?
So I think from that point of view, first of all, I'll talk about what all means for this particular product itself. This particular product does not, in a way, is affected by, let's say, no fund managers involved in taking stock level calls or a sector level calls. This particular fund is only giving you beta returns, or rather the market returns, which are associated with large and mid cap segments. So from that point of view, if you feel that you want to take that market exposure, for a short duration or for a longer duration, participate in market upward movement at a very low cost. I think this makes a lot of sense, especially let's say if you're concerned about if market will do well or not, and if you're concerned about the underperformance. I think you should rather invest in a low cost product than a high cost product where because of such costing the underperformance can be on the higher side. But on the market side, we as a Mirae asset, we feel that markets right now should be looked from the next 2 or 3 year earnings point of view on what the next earnings next year earning will be this particular financial year. We should not focus more so from the earning point of view and look at the next 2 3 year earning. And also we should also be focused on the fact that because interest rates are down, it will be a huge it will provide a huge impetus in kinds of market valuations going forward. So while we feel that some sort of consolidation may take place in the market right now, but if you are looking from a 2 year or 3 year point of view, both from the earning perspective and where the interest rates are right now, we feel that market from a long term perspective still makes a lot of sense both in terms of returns.
Great, thank you for that. The next question is from Mr. Vinod. The query is why not a Nifty Junior? Probably if we can just briefly touch upon the 3 ETFs that this fund comprises of. I think that will give some clarity.
Yeah, so one of the product in which we this particular fund will be investing is Nifty Next 50, which was earlier called as Nifty Junior. So from that point of view, I think we are already addressing that concern. I personally like that product a lot, and through this fund of fund, you can take exposure to Nifty Junior. So and see, I am also an investor in both Nifty 50 and Next 50. But one of the questions which we have right now, there are two questions. One is how much should I invest in Nifty Next 50? How much should I invest in Nifty 50? How much should I invest in mid cap? That is getting taken care by this fund of fund. And when should I shift my allocation? Again, that is getting taken care from this fund of fund. And lastly, if you are buying Nifty 50 or rather Nifty Next 50, you are there are some concerns, let's say people have around the liquidity, if on the exchange right pricing is available, if let's say the spread which is there on the exchange, the impact cost, is it on the higher side, and will it eat into your returns of that particular ETF? Now this fund of fund will take all those concerns away because we'll be investing directly with the AMC when we are trying to buy or sell ETFs in most of the cases, and hence all those cost or all those liquidity concerns or all those liquidity spreads which eats into a typical investor returns will not have a significant impact or a higher impact in this particular scheme. And I think if you want to take a broader exposure through these 3 ETFs, you can simply invest and get that through this fund of fund.
Great, thank you for that. The next question is from Mr. Kamal. In general, it is recommended not to have too much of diversification, but in this fund of fund, we are basically looking at 250 stocks, that is 100 plus 150, 50, 50, and 150. How rewarding the returns in this case would be, considering the span is large?
Okay, so I think that's a very good question. So see, you only need to look at the recent data which is coming out. In fact, you can look at the last 2 3 years data on how these simple diversified ETFs are doing, right? If just go ahead and compare the performance of Nifty 50, Nifty Next 50 against the mutual funds, a very diversified plain vanilla exposure right now is giving you very good returns. The mutual funds are finding it difficult to outperform them, especially post the cost they incur to manage that fund. See, you have to understand in a very simple manner is that or if a regular plan of a mutual fund is north of 2% and ETF, a Nifty 50 ETF is available at just 0.1% in terms of cost, a fund manager has to outperform the Nifty 50 ETF consistently by 1.9% so that you get similar returns. And that is what is becoming more and more challenging. I feel that even such diversified plain vanilla ETF makes a lot of sense. Just look at US. Even in that developed market, one of the most talked about product is on the passive product, and in the overall investment community is Nasdaq 100 and S&P 500. Even the evolved mutual fund industry and the hedge fund industry and all those industries are there, but still people are finding S&P 500 and Nasdaq 100 very simple diversified products, a very compelling investment options, and their AUM are like pretty high. And same thing are now we are observing in India also.
Great, thank you for that. We just take the last couple of questions. The next one is, what are the modes of buying into this fund? Is there an option of buying it with the AMC?
Yes, this is while the name is fund of fund, it works very similarly to how mutual fund is. You can log into your you can go through via any distributor, or you can come directly to the AMC and buy this particular or invest in this particular NFO. So everything is same as how you subscribe or redeem from a mutual fund. So it's again, as I mentioned a couple of times in my presentation, it's a very convenient offering, uses a mutual fund way to basically for investments and redemptions.
Okay, we'll take the last question for the session. Is there an SIP mode in this fund?
Yes, so I think that is one very interesting or rather additional benefit which this fund of fund has. You can use the SIP mode to invest in this fund of fund, which is typically not there in case of ETFs directly from the AMC. People like HDFC Securities, I know that provide SIP way to invest directly in ETFs also, but directly from the AMC that is not the case. But in this fund of fund, like mutual funds, you can invest via SIPs also.
Great. Thank you so much for that. I believe we'll have to end this session here due to paucity of time again. Thank you so much, dear investors, for taking time out and logging in. Thank you, Siddharth, for a very, very enlightening session. It is quite useful. We will keep having these sessions periodically. Thanks a lot once again, and thank you, investors.
Thank you, Ganesh, for having me here. Thank you.
Yeah, Shyam, we can close the call now.